Good evening, everyone. On behalf of Niyogin Fintech Limited, I welcome all of you to the company's Q4 and FY22 earnings conference call. I am Sonia Keswani from Ernst & Young IR Practice, and we manage investor relations for Niyogin Fintech. You would have already received the Q4 and FY22 results and investor presentation, which is also available in our filings with BSE. To discuss the company's business performance during the year and future outlook, we have with us today Mr. Tashwinder Singh, the Chief Executive Officer and Managing Director, and Mr. Raghavendra Somani, the Interim Chief Financial Officer of Niyogin Fintech Limited. Before we proceed with the call, a disclaimer. Please do note that anything said on this call during the course of the interaction and in our collaterals, which reflects the outlook towards the future or which should be construed as a certain forward-looking statement, must be viewed in conjunction with the risks the company faces and may not be updated from time to time. More details are provided at the end of the investor presentation and other filings that can be found on our website www.niyogin.com. Should you have any queries or need any further information at the end of this call, you can reach out to us at the email addresses mentioned in the company collaterals. With that, I would now like to hand over the call to Mr. Tashwinder Singh. Thank you, and over to you, sir.
Yeah, thank you, Sonia. Let me start by thanking all of you for joining us this evening. I welcome you to Niyogin Fintech's earnings call for Q4 and for the full year 22 results. Before I delve into the performance, I would just like to give you a brief on our company. As most of you would be aware, but some of you may not, Niyogin Fintech operates on a tech-centric platform-based model, wherein our banking as a service platform serves both rural and urban India through a partner-led strategy. The BaaS platform, which is the banking as a service platform, is employed by our partners in customer-facing touchpoints like retail storefronts or SMEs that enable these touchpoints to provide basic banking services to their local communities. Moreover, under our partner-led strategy, we reach out to a large number of SMEs through every partner we onboard, which gives us a low-cost market access. We can then incrementally add products for the end customers, all the while providing income augmentation for these partners and retailers. To reiterate, our business is premised on an open tech architecture platform with a transaction-based revenue model. Our objective is to deliver a capable financial services infrastructure platform that powers all distribution customer-facing businesses. Our execution is focused on two broad vectors. One, to continuously expand our platform capability, and number two, to keep scaling partners. We have made significant progress in both these areas in the years gone by. Some of this you would have seen in our presentation that we've given along with our results. I'm very happy to let you know that we have crossed the important threshold of rupees 100 crore revenue in FY22, which is a significant milestone in our journey towards acting as a partner for financial inclusion. This performance has given us the confidence in our stated strategy and the execution capability, also enabling us to accelerate our growth and maximize the potential of the market that we are focused on. Talking of the quarter gone by, we delivered our fifth consecutive quarter on sequential revenue growth, 13% in this March quarter over the previous quarter. This has been led by our network expansion as we added more than 55 new partners to our network and linked over 18,000 retail outlets to our network, bringing our overall footprint to close to 250,000 retail points. In the following quarters, we expect this momentum to accelerate. We also had some very marquee customer wins through this quarter. We have now joined hands with India Post Payments Bank to deliver multiple solutions to bolster their digital banking strategy. This is a significant and material, win for us. As a technology service provider, we will be deploying various innovative digital banking solutions in the network as well. The last quarter marked the launch of our proprietary switching platform, iSwitch, on MPCI's NFS network in collaboration with IndusInd Bank. This is India's first cloud-native switching solution, and it will help our banking partners achieve their goal of providing a frictionless end-user experience at scale while being wholly compliant with all regulations. We are also working with an upcoming neobank to launch a prepaid card solution for their customers. These are some examples where our new propositions are finding favor with the market. On the platform capability, we have been investing in our tech stack. so our services can be consumed as a full stack application, an API or an SDK. This will allow us to onboard all varieties of partners as we continue to broaden our product stack and enhance our value proposition. On the urban tech, we also saw some strong momentum in our business with our SaaS solution on analytics finding some good favor. These strategic alliances and technology build should enable us to propel the organization into a hypergrowth mode. I had mentioned last quarter about the hypergrowth strategy that we had detailed out. In Q4 2022, we announced our first tranche investment of 50 crores in ISerview, our subsidiary. This aligns with the hypergrowth strategy in which we stated that we would invest up to 100 crores in establishing our intellectual property, which spans several products like neobanking solutions, POS solutions, and prepaid cards, to mention a few. We will be developing and launching various items across all our business lines over the next 12 to 18 months. The market potential and the ecosystem in which we operate excites us greatly. We think of ourselves as an API infrastructure provider, and we think that the opportunity space for us is quite huge. As stated in our previous calls, we are committed to reach our goal of becoming a 500 crore company, a 500 crore revenue generating company by FY25. We believe we can improve our GTV from the current 9,000 crores, give or take, in the last fiscal to over 100,000 crores in the next 3 years. And we think we can deliver profitable results to our shareholders. We think the EBITDA margins of our business in year 3 should be in the 10 to 12% range. We believe that as we scale, we will reach a tipping point in terms of product and distribution, resulting in higher long-term returns. That's a quick rundown of what we've accomplished or what we expect to do from here on. With that, I now turn over to Raghvendra to take us through the financials and other details of Q4 and FY22. Post that, we can open this up for questions and we can address all your queries. Thank you, and over to Raghvendra.
Thank you, Tash. Good evening, everyone. Highlights for the Q4 FY22. Our platform metrics have been performing well. In rural tech, our gross transaction value, that is GTV, including the payout, stood at rupees 24.3 billion in the current quarter, an increase of 37% YOY. Our average transaction size in the rural tech business grew by 1% YOY and stood at rupees 3,792 in Q4 FY22. On the urban tech front, our partner count increased by 25% YOY and stood at 5,010 in Q4 22. Our wealth tech platform continues to perform well and recorded 122% year-on-year growth in the AUM, which stood at rupees 21.9 billion. Moving on to the financial for Q4 FY22, consolidated revenue for the quarter was rupees 312.8 million against rupees 183.9 million in the corresponding quarter last year, an increase of 70% YOY. Adjusted EBITDA, excluding the ESOP charge, which is non-cash in nature for the current quarter, was a positive rupees 14 million as against a negative 25.6 million in Q4 of last year. ESOP charge for the current quarter was rupees 12.2 million versus rupees 15.2 million in the corresponding quarter last year. The non-GAAP PBT stood at positive rupees 0.8 million in Q4 of this year as against negative non-GAAP PBT of rupees 40.7 million in the corresponding quarter last year. Loan book net of provision stood at rupees 577.7 million, up 22% Q-on-Q, led by the transaction-based credit. On a full year basis, we crossed an important milestone where our consolidated revenue doubled and increased 111.5% to rupees 1,070.8 million as against 506.3 million last year, primarily driven by our rural tech business. Our EBITDA was a positive rupees 29.6 million in FY22 as compared to negative rupees 20 million last year. Our full year non-GAAP PBT was a negative rupees 24.3 million in comparison to negative rupees 39.1 million in FY22. Our ESOP charge for the full year was at rupees 53 million as against rupees 33.4 last year. We continue to remain zero debt and net cash company. Our cash in hand stood at rupees 869.9 million on balance sheet date. With that, Sonia and Ravi, we can open the floor for the questions. Thank you.
Thank you, Raghvendra. We now open the floor for questions. I request participants that in case they wish to ask any questions, you may please raise your hand Persons may please note that that those who will be raising their hands will be taken on a priority basis, and we request people to raise their hands and come and ask questions rather than going to the chat mode, because people who raise their hands will be taken on a priority basis. And in case you are representing any institution, we request you to state your organization's name. Thank you. We'll wait for a minute before the question queue assembles.
I think while the question queue is assembling, I do want to mention there is a question regarding the EBITDA goal, right? So, this year has been very interesting for us, right? So I think Raghavendra articulated all the numbers, right? But I do want to make a few mentions on some numbers, right? If you look at just the Q4 numbers, in Q4, our revenues have grown by 70%. Our expenses have grown by 35%. That is one data point that I want to leave with all of you. Number two, if I look at full year performance, right? This is the first year where we've turned EBITDA positive. We had, on an adjusted EBITDA basis, almost 3 crores of EBITDA that we have delivered in the market. Now, if you are able to continue with the trajectory, or if you are able to continue with the trajectory as we shown in Q4, where our revenues start growing faster than the way our expenses are growing, I think, in the next 3 years, the plans that we've set for ourselves should be quite, relatively easy to achieve, right? They're obviously towering plans, but we feel pretty confident being able to achieve that. I do want to articulate that I did mention in my opening remarks that we are looking to get to 500 crores in 3 years of our operation. We think our GTV, which I think is going to be the driver of our revenue base, will be almost 11x of what it is today. Today we are at about 9,000 crores. We think we'll get to about 1 lakh crores. And we think that this business will deliver between 10 to 12% EBITDA margins at that level, right? So that is, I think, the broad set of goals that we set for ourselves. I also want to mention a couple of things. There have been some very important wins. I think the partnership that we now have with India Post, which is a new partnership that we've done, where we've got some level of exclusive partnership on some of the digital products that are being launched by them, are all going to be powered on our platform. Now, it's a material thing. These things take time to show up in the numbers. Typically, it takes 3 to 6 months before the numbers start showing up. But the fact that we've signed contracts, we've got all the business in, the commercials have been closed out, and we are already working on integration, I think gives us tremendous amount of confidence on being able to achieve the set of goals that we set for ourselves. So I'll just pause here and see if there are any questions people want me to get deeper into.
Thank you. In case anyone wishes to ask a question, you may please raise your hand. Mr. Sanjay has posted a question on the EBITDA margin, whether the 10 to 12% is the EBITDA margin which is being projected in the future. Is that right?
That's correct. That is the goal that we are targeting for the company as our 3-year vision plan. I think on that, I just want to add one more point. The company has, if you look at the cash burn, we've not been burning cash, and primarily because we are not a B2C company, we are a B2B company. As a B2B company, a lot of our marketing efforts is directed towards enterprise partners, right? Where the efforts involved are very different compared to B2C companies, right? So I think we've been able to manage our growth, without necessarily demonstrating significant burn. And that is the ethos, I think, how we want to build this business. I don't think we want to build this business, just by not being focused on the bottom line. So that I think is one thing which is important. Having said which, we've also said very clearly that we do want to invest in our businesses, and we are looking to invest. We've done the first round of investment of 50 crores into our subsidiary, where we would be, obviously spending the money on building our intellectual property as against just using that money for marketing and getting customers, right? So that's really the difference in the way we are thinking about growth.
Yes. Mr. Sanjay Avatramani has a follow-up question, whether you can list some competitors in this space.
Yeah. So there are lots of people, and competition is different for different segments of our business. But the core business on what we call as the API infrastructure play, right? Some of the players like Open, or you look at a entity like Zeta, or you look at Setu. These are people with whom we compete with, right? On the NBFC side, which is also part of our business now, and Niyogin has an NBFC license. It's obviously starting to lend, as I had mentioned in my previous calls. We are trying to leverage our network and trying to see how we can lend within the network, which means we are not necessarily lending across the entire street to anyone and everyone. We are focused on just trying to be very, very focused on how we deploy the capital that's on our balance sheet. But looking at some of the other infrastructure players, I would say M2P, Zeta, Open, Setu, these are the players who I think are real competition for us.
Thank you.
I think there is a hand up by Mr. Deepak Podar. Maybe we can take his question.
Yes, Mr. Deepak, I have allowed you to talk. Please go ahead.
Yeah, am I audible?
Yes, you're audible.
Okay, so my question revolves around your guidance. Now you spoke about 100 crores going up to 500 crores in 3 years. So that's about 70% CAGR we are talking about, and even on the EBITDA margin from currently 3% to 12%, maybe in 3 years. So just wanted to understand the trajectory. So you expect this growth journey to be equally distributed over the next 3 years in terms of.
So I don't think it will be distributed equally, Deepak. It's a good question. See, we are in a build phase, right? And we've just invested our initial capital of 50 crores in what we want to do in the whole rural financial inclusion space, right? The next year is going to be a year of build for us. Certainly we will grow because we have got, fortunately, the tailwinds and the momentum of what we've done this year. That will help us continue with our growth trajectory. But I think the real leap we will take will be maybe the year after next. That will see a significant jump, because next year we will continue with the build. We will continue to show similar growth rates, right, that we have showed this year. And then the following year is when I think we will really take that big jump in terms of the business going up.
Okay. So what you are indicating is that our growth would be little back-ended. FY23 might see a moderate growth, but the real growth might be visible in FY24 and FY25, right?
Yeah. I don't know what the definition of moderate is, Deepak, because that varies for various industries. In our industry, moderate growth also needs to be above 50%, 50-70%. Anything below that is meaningless. So yeah. I think our motivation is that, we should be delivering significant growth every year. But the second year from this year, not the first year, the second year will be significantly higher than next year. Next year will also show growth because, like I said, some of the contracts that we've done, whether it is with a CSC or with the India Post, right, or with the Bhafin or with multiple other partners, all of these are going to come to fruition this year now. From this quarter onwards, the quarter that we are in right now, I think you will actually start seeing the jump in our GTBs and therefore in our revenues. Right. So you'll start seeing that impact coming in, because we are now concluding on some of the integration projects that we started, which were all announced maybe 1 or 2 quarters earlier. But it takes time, right? 3 to 6 months it takes before the revenues start necessarily showing up.
Correct. I understood. But in terms of margin, you did say that we expect revenue to grow faster than expenses, right? So it would be fair to assume that your EBITDA margin will keep on improving year on year.
Yeah, so I think that would happen. The only caveat I would make, Deepak, is next year we are also investing a lot of money, right? So I think next year you may not see the significant jump in that sense, right? You will definitely see significant growth. But I think, like I said, we are not building businesses of just putting in the money and then worrying about where the revenues come from. We are building our business on a modular basis. So when I say we are doing a Neo Growth proposition, the Neo Growth proposition is already ready. We are going to be launching it in the course of the next couple of weeks, right? That investment's already got done. And now we've got incremental product propositions, for example, prepaid cards, etc. We are going to start the build on that. But as we are starting the build on that, we hope that the revenues from the new banking business will start coming into play. And therefore that will defray some of the expenses that we'll have to do for the new build. So we are being sensible. It's not just about, okay, let's just go build, keep our eyes closed, right? We are trying to build, launch, and then continue the build on the next side. So it's in some sense a little sequential, not totally sequential, but a little sequential.
Okay, I understood. And what's the investment we're talking about? Like 50 crores investment we have already done, right?
Yeah. So we had, in our business plan last quarter, we had articulated that the entire vision that we have will require the spend of about 100 crores. And it's not that we need to put the 100 crores on day one. It is about building the business. We have to build the right sort of, product set with the right partners, right? So part of it's not only about the build, it's also getting the right partners. Like we've got India Post as an example, like we've got CSC, like we've got IndusInd, we've got a lot of other banks as examples, which are all partnering with us. And there are different solutions. We are working with different institutions, right? So it's a business build. The capital is obviously required for the tech build, but the tech build has to go in sync with the business build. There's no point just doing the tech build without necessarily having the business build come along with that, right? I think both have to go together.
Okay. So FY23, we are targeting incremental 50 crores investment. 50 crores you said we have already done.
50 crores we have already done. I think our plan was to put another 50. But like I said, we are going to be calibrated. So I don't want to give you a commitment that the 50 will immediately go in the next 12 months. We had said that we would do it over 18 months when we had said that announcement last quarter. My vision and my want and my ask is to do it sooner rather than later, because I think that will help us scale faster. But I don't have a date I can tell you by when the balance 50 will go in.
Okay. Yeah, that's it from my side. All the very best. Thank you so much.
Thank you, Deepak.
Thank you. We have a question in the chat box from Mr. Subrata Sarkar. Mr. Subrata Sarkar is asking why our revenue growth expectation is lower than our GTV growth expectation.
So our revenue growth expectations is going to be different from our GTV growth expectations because we are getting into newer products. What happens is when you get into newer products, the revenue potential of the newer products or the margin potential is different from what we've seen in the past, right? If you look at the unit economics of our current products, right? When you look at a micro ATM or you look at a AEPS or you look at a DMT, which are really the core products that we are operating in today, right? That has a significant higher revenue potential, right? In the newer products that we are getting into, Neobank, there is again revenue potential, but because we'll be breaking into that market, sometimes we may need to go with a lower sort of revenue, pricing to break into that space and to create a footprint there. But like I said, in all cases, our unit economics are going to be profitable. I think we are very clear about that. But you may see some change because of that. Also, some of the products, the whole concept of GTV, for example, neobanking, if you have a bank accounts being opened on our platform, on our app, you're going to have bank accounts being opened, savings account, current accounts, right? Those don't really flow into the GTV numbers. So one needs to look at the whole definition of GTV also needs to undergo a little bit of a change, which we will all calibrate as we go along.
Thank you. We have a question wherein Mr. Rahul has raised his hand. Mr. Rahul, I have allowed you to talk. Please go ahead.
Hi. Hi, Tash. I'm sorry I joined the call, I think about 5 minutes late, so I'm not sure if you have touched upon this, but here's my question. In your investor presentation, you kind of mentioned that your activation rate for the urban tech has dropped to about 12.9 versus 20.3 a year back. So yeah, if you could throw some color on this, please.
Yeah. So on urban tech, I think, the focus of our business proposition has been to try and enhance incremental products. So we went back and did a little bit of soul searching on what is it that we're doing on the urban tech and how can we really get into a hyper growth mode there as well, right? The whole hyper growth plan was more about rural tech. Rural tech business completely seems to be trending in the right direction. On the urban tech side, I think we decided, if you notice, we have about 5,000 odd chartered accountants and intermediaries that log onto our platform. And primarily what we were doing was fundamentally distributing loans through that platform, helping them meet the objectives of their MSMEs and SME customers by getting them on our platform and fulfilling the needs that they have. And on the right side, we tied up with a bunch of service providers or capital providers and what have you. And we went back and started thinking about what else can we do with this ecosystem, right? So this quarter, we took a little bit of a decision on saying, let's enhance our product stack capability. So we are now getting into insurance in a big way. We've tied up with someone for HRMS, where we're going to bring in incremental products which are non-financial in some sense, also on the product, right? And both in terms of the number of new partners that we added last quarter versus the activation of the partners that we did last quarter was actually slowed down a little, primarily because we did a bunch of focus groups. We were trying to figure out what are the right product stack that we need to bring into this market to be able to then really take it to the next level. So there's some work that's happened. We also are launching a new platform, right? So there was some work happening on refurbishing our current platform. So a lot of build work happening, which led to a little bit of reduction in that activation rate. But the customers are all there. We are very closely in touch with most of our partners, right? And some of the new things that we are doing now in that space, which I will allude to in the next couple of quarters as we bring those out, I think would be very, very interesting. We've got some interesting partnerships being done with some insurance players, where we're going to bring insurance on our platform. There is, like I said, HRMS actually providing. We found that HRMS is a solution that most chartered accountants are actually providing to the MSMEs. Automating that function was a huge activity that they were all looking forward to. So there's been a little bit of a to and fro on that count, but you'll see these numbers improving significantly in the next couple of quarters.
Mr. Rahul, does that answer your question?
Yes, I have just one last question, if that's okay.
Please, go ahead.
So this, you have set yourself a very ambitious target for the next 3 years. Does it rely a lot on how your product stack is currently placed in terms of, or does it also rely on you getting a lot of things right, as you have already alluded to, like with your urban platform and your rural platform, you do have plans to invest up to like 50 crores and more. So how much of this growth is kind of like, based on, I don't know if I'm putting this right, based on everything that you have been doing versus what you're planning to do with your platform?
Yeah. So I think it's a tough question to answer, Rahul. I'll be honest, because it's not that we have everything sorted for the next 3 years, right? It'll be unfair of me to say that we have everything sorted for us for the next 3 years. This is a build phase for our company, and we're learning, we're building, and I think we are delivering, right? That's the way I think about life. Now, why we felt confident about the targets that we set for ourselves is because some of the tailwinds that we have, some of the contracts that we've been able to win, some of the conversations we've had with significant and material partners in the market have been very, very encouraging for the lines of business. And a lot of new product build really comes in not because we've thought in some isolated ivory tower of what the product should be on the ground, but these are ideas and thoughts that are coming from some of our large partners. Some of the conversations we've had with CSE, right, where they've told us that there are 650,000 retail outlets across the country, and I've mentioned this on a previous call, right? What do they want to see on the ground? How do they want to deliver to the last consumer in rural India is really driving a lot of the build that we are doing, because we are powering them, we are partnering with them. You look at India Post, right? They are probably, if you look at the last, budget speech of the finance minister, they spoke about India Post being a significant, entity to deliver financial inclusion. They've chosen us to be their partners in the delivery of financial inclusion. Now, it's not straightforward to just say, okay, I want to do a micro ATM. I'll give you an example. They have plans to do something which is called a digital money order. Very interesting proposition, right? And I'll take a minute to explain to you. Today, through Jan Dhan Yojana, 430 million bank accounts got opened. How does one transfer money to somebody who does not have a bank account? So significant number of people have bank accounts in the country, but there is still a large portion of people who don't have bank accounts. India Post is the only entity that's able to provide the old historical money order proposition of delivering money to people who don't have bank accounts or who do not have ability to go access a bank account, right? Now we are working with them to create something called a digital money order. That's a proposition which is their product. We will provide the entire technology stack around it, and we will deliver that proposition for them. So there are some very interesting innovation that's happening in the market. I can't take credit for this innovation. I have to say the innovation is being worked on because the customers have product ideas, and we are providing them with the execution capability and the platform for being able to deliver those execution ideas. Now, as we keep scaling and part of the belief is that our customers' own belief that how big that product could be. And the way we built our business is we're not a classic technology company where we would deliver a certain product and get paid just for making that product, right? We are a transaction revenue company, which means that we make the product, but we get paid based on a small fee on every transaction that gets transacted on our platform. Which means that if you really think about it, if our customers have a win product, right, and that really scales up, we will keep making money on every transaction that gets transacted on that platform. So in some way, one can argue that there is a long tail of revenue that could come our way, right? We think we have so many ideas which are there on the table right now, which are all under execution in some form or shape, right? That some of these will be big hits, and that gives us the confidence that we will be able to achieve the numbers that I alluded to earlier.
Thank you. Mr. Rahul, does that answer your question?
That was very insightful, Tash. Thank you. Thank you for answering my questions.
Thank you, Rahul.
Thank you. The next question we have is from Mr. Pratik Sahu. Pratik, I have unmuted you. You may please go ahead.
Hi, Tash. I have a few questions. So I'll just go in order. One, is there any update on the Axis Bank NSDL partnership? I think you mentioned that briefly in the last call.
That's right.
I have a couple of more. One is we saw that there was just a marginal bump up in the average transaction size. What is the stable transaction size, what you are expecting over the next 3-year period? The third question is, out of the 500 crore top line, the hypergrowth top line, what you're targeting, how much of it is, I would say, more in terms of logged in visible revenues attributable to some of the partnerships, what you are already logged in, right? And how much of that is fungible? So these were my initial questions. I'm happy to hear.
Yeah. So let's take one by one, right? So firstly, on the NSDL bank, Axis Bank, they are two separate partnerships, by the way. They are not the same. They're two separate institutions, right? So we are working on integration with both of them, and we will be announcing some launches in the course of the next couple of weeks with both of them, right? So there again, the partnership was more neobank linked, where we were working on trying to get a bank where we could use our front end to open bank accounts, which could be current account or savings account, in the whole financial inclusion space, which is in the second, third tier towns and rural areas, right? So that proposition is underway. Like I said, it takes a little bit of time in terms of integration, etc. We announced the partnership last quarter. This quarter, we are pretty much done with most of the integrations, and in the next few weeks, you will hear about some launches that will happen on this count, right? So that should answer the first question. In terms of transaction size, I think the transaction size of 3,700, give or take, I think this is where it's normally settled, right? So thanks to inflation, etc., the numbers could go up a little, but I wouldn't worry about that. We track it very closely because we like to see what is the total number of transactions that are transacted on our platform, right? We do more than 6 million transactions, give or take, So it's just good to keep a data point. I don't think this is really driving anything which is different. The transaction volumes are going to be very different in rural India versus urban India, right? These numbers are driven more by the level of money transfers or the level of withdrawals that happen largely in rural India. So I wouldn't really try and draw any conclusion from if this number going up or down, what that really does to us, right? So that's on second part. On the third part, it's a very interesting one, right? 500 crores. Do you have it in the bag? That's really the question, right? With the partnerships that we have. Now, some of the partnerships we have are very, very large. Just to even juice out the entire revenue potential of each of those partnerships, right, is going to take a lot of time and effort and energy from our side, right? So, like I said, we have 246,000 retail points that we have sort of logged onto our platform. But if I just look at the potential of the partnerships, we could be over 1 million. If you just add the 650,000 of CSC, you add, call it 200,000 of India Post, you add 125,000 of Bharat Financial, and then you have the smaller partners all putting together, right? We could well over be 1 million if we could execute them pretty quickly and get them done, right? So there is a significant premium I'm putting on us in the team, on people, on execution. I think there is a lot more to do with execution. We have front-loaded the proposition. We have front-loaded our ability to demonstrate to the market that this product works. This product makes money. There is a profitable way to deliver financial inclusion. Now it's the question of how the scale comes in. And the beauty about the scale is that the scale is not something that I need to go hunt in the market to get the scale. It's about executing what is already there in the system. So if I do a fantastic execution, yes, this number looks easily doable. But if I go slow on my execution, and it's not only me, right? It's not only Niyogin and ISW. It's the partnership with these people, with our partners, right? So with the partnerships, when you work, the speed at which some of our partners work also becomes important. How they want to bring new products into their ecosystem, how they want to provide new propositions. They all have front ends. How do we integrate with their front ends from a technology standpoint? Then there is the whole education that happens to their front ends, which is the VLE or what have you, their front ends. So there are a bunch of things that have to happen for these things to get executed. If you ask me, does the potential exist in our network today? I think absolutely. But we have to deliver. We have to deliver, and it's not something that delivering is just switching on a button. It's a daily activity of, being there, out there, trying to get things done, right? So it will take time. That's why we put ourselves a 3-year target rather than a 1-year target. Pratik, does that answer your question?
Got it. Yeah, it does. I have a few more questions. Can come back in the queue if there are other people waiting.
Yeah, I think I can see Suraj Kumar's hand up. Maybe we can take this question.
1 second. Yes, Mr. Suraj Kumar, I have unmuted you. You can please go ahead.
Thanks for the opportunity. I would like to ask what about iSerview? The auditor has resigned recently. What was the reason for auditor resigning?
So auditor there was no reason other than the simple fact that when we acquired the company, this was part of our shareholder agreement that we are a listed company. We want the quality of auditors, etc., to be of the governance, to be of the standard that we would expect. There's been no issue. The auditors are absolutely fine. In fact, they will continue to be engaging with our group actively. But we felt that as part of our shareholder agreement, right, there was a plan that in 1 year we would change the auditors and get them to a level. Because, iSerview is a great company, but it's been a homegrown company which was started by 4 founders in Bhubaneswar. They had a local person who was an auditor. We wanted to get a slightly more high-profile person into the audit. And that's why that's the change. There's absolutely no other reason why a change has been done there.
Thanks for clarification, sir.
Thank you. We have another question from Mr. Pratik Sahu. Mr. Pratik, I have unmuted you. You may please go ahead.
Thanks. I'm just continuing from, I think, a question which another gentleman asked on the call, right? Wanted to understand, how do you define the activation rate for a rural tech or a wealth tech? Like, is it the retailer getting activated for what period? The second, I wanted to understand, there was some loan book growth, right? So at a steady state perspective, as in the revenue mix, right, how much of it are you targeting from an interest income versus the fee income, which is the core of our model?
Yeah.
And third, while you have alluded to from a 3-year horizon, because of investments, etc., we'll be reaching at a 10-12% EBITDA. But from a steady state perspective, where do you see those margins landing up?
Okay. So all good questions. Let me take them one at a time. So first question was really about the loan book, right? Let me address that first, right? So the way we think about our numbers today, and if you look at our numbers, about 20%, actually less than 20% of our revenue is interest income. It's about 18-19%, give or take, right? I don't think that number is going to change. We are still a fairly fee income focused company, and we want to be that. We don't think of lending as a first product in the market. We're not out there, I don't have any, what should I call, Niyogin branches existing, because if I was doing lending purely for the sake of lending, I would need to create my footprint across the entire country, right? We don't do that. We don't have that. Our approach is that for the network that exists, right? And we're talking about 246,000 retail outlets, for example, and there are partners above the retail outlets, right? Which is about 600 odd plus partners. When I look at that ecosystem, that is the ecosystem that I want to spend my money on the lending side. Because to me, that is giving me a double whammy or a double bang for the buck. Because that customer, which is a retailer customer, firstly earns money off me, because every transaction the customer does, right, I pay them for that transaction, right? Because our products are all income augmentation products, as I explained earlier. So for me to be a golden goose for that retailer, the retailer does not want to default on me. So I actually have better credit data. Firstly, I have information of how much money he makes off me, which is a good data point for credit underwriting. Number 2, that person has an ongoing business with me, which means that he does not want to default on me, and we have a closed loop wallet arrangement with him, which means he has to open a wallet with us, and I'm able to transact through the wallet on the loan side as well. So I can debit the wallet to collect the EMI, and I'm anyway crediting the wallet for all the payments that need to be made to the retailer for the business that he does on our platform, right? So that's the ecosystem on how we are building out the lending shop. Now, there will obviously be other incremental lending opportunities, which could be through the FLDG route, where other fintechs who are using our platform for other delivery will also come and tell us that, listen, why don't you also lend to us? Again, not the only steady state single trick pony product, but more like a completion of banking as a service proposition where we provide that. So The lending business will grow. It has grown in the last quarter and it will continue to grow, but it won't grow to overtake the fee business. I think fee business will continue to be between 65 to 75% of our revenue base. And I think we want to keep it that way. Actually, more than 70% is what I would like to see on how the fee business sort of develops. That's one. Number two, I think you had a question on the activation rate, on how do you define activation rate. Activation rate is typically customer has to do a transaction in a month. It's not driven by just a customer getting activated on our platform because he's downloaded our app or he has basically got himself registered with us. Right? Those are all good things, but he has to do a transaction. There has to be a revenue transaction on our platform, and that defines activation for us. So the activation is the customer is finally experienced us. A customer defined as the retailer here has experienced us and has actually seen a transaction flow through, and therefore effectively has made some money off us. And obviously we've made some money off that transaction. Sorry, I forgot the third question. I apologize. Could you repeat the third question?
What would be the steady state EBITDA margin long term? And just on one question, value tracking activation, would you at some state also look as a retention, right? Because I think post acquisition also, I think retention over a slightly longer period is when you will start getting the lifetime value of that customer. You will choose more from the partner and the customer, right?
Yeah. No, absolutely. I think these are all data points which I guess we track in some form or shape, but I think there needs to be more discipline on tracking. Retention is a data point that we spoke of some time back internally. We have now started tracking it. Obviously, we've not shared data, but yeah, absolutely right. I cannot agree with you more on that. Steady state EBITDA is a difficult one to answer, right? Because the products that we are delivering, incremental products are coming in, new ideas are coming in. I think steady state, the business should operate at least at a 25-30% gross margin, and then EBITDA should be at least 15% on a steady base. 15 to 20% is the steady state number I would like to get to. But our first real milestone, I think this business, we are driving it on a milestone basis. We set targets for ourselves on a milestone by milestone basis. And our next milestone is to get to the 10 to 12% EBITDA margin number while delivering significant growth on our top line, right? So, haven't really thought about it from a steady state, what this number would get at, quite honestly. I don't want to throw a number out there randomly, right? So let's just go milestone by milestone. And as long as we are delivering in the right way, which means we are increasing our revenues, reducing or having a lower growth in our expenses, I think we'll get there.
Got it.
Sure.
I have more questions, but I'll come back in the queue.
Sure. Thank you. We have a couple of questions in the chat box. Mr. Sanjay Avatramani is asking as to how is the revenue recognized? Is it transaction based or subscription based? That is question number one. Question number two is how does the cycle move for the partners? When we add a partner, do the revenues flow in from the same day itself? Thank you.
So it's a mix of transaction and subscription, Sanjay, just to answer your question. And I'll break it up between rural and urban fintech, right? In rural fintech, which is a large portion of our business, what we do is when we add a new partner, there is a certain integration fee we take, call it subscription fee, integration fee, you can call it what you want. We take that as a one-time fee from the partner. And then it's all transaction based, right? Beyond that, it's all transaction based. Subscription would have been an annual payment. We don't have an annual payment construct. We have a one-time payment construct, which is more integration, etc. And then it's all transaction based. So that's how the model works. In the urban tech platform, the CAs are logging onto our platform. There's no subscription really. It's all transaction based. All right. So we are trying to make it more easy for people to come and deal with us. In our wealth tech business, there is a subscription based but it's a very small part of our business. So frankly, not really moving the needle for us. How does the cycle move for the partners? When we add a partner, will the revenues flow from the same day? So what is the work required when a partner is added? When the partner is added, the partner has to do a couple of things. Firstly, if the partner has his own platform, we integrate into that partner's platform, which means our product stack becomes an icon into whatever front end the partner may be using. It's a web-based solution or it's a mobile app. We can just put in our SDK or they can do a full integration with us. That's number one. Number two, the partner needs to have the digital devices which could be either the authentication device for a fingerprint or of a ATM card, if it's a micro ATM. Those devices need to be in the retail front ends, right? Now, once you've got the device in the front end and you've got our technology integrated into their core system, they're good to go. Because by integrating, they connect to our switch. And I mentioned in the earlier part of my conversation, now we have our own switch, right? InterSync has sponsored our switch with MPCI. And it's actually India's first cloud native switch. So, we can get technical if you like, but it's very interesting. And it's unique. So we've got our own switch, which means our cost structure is better than other players in the market because we are directly connected to MPCI. We don't need to pay anybody to connect to MPCI directly, right? So that takes away a little bit of an expense base for us. And this business is about, I mentioned this in my previous call as well, this business is about pennies. This business is not about dollars. So you need to save all the pennies that you can save in the business to make big money eventually. So that's how it works. Now, when a transaction gets done, the partner makes money. Every transaction that gets done, the partner makes money. So it's not about the partner signing up, it's about the partner transacting. I don't know if that answers your question, Sanjay.
Sure. Mr. Sanjay has said that it is clear and said thank you. Yeah. We now move on. Mr. Pratik Sahu has a follow-on question. Mr. Pratik, I have unmuted you. Please go ahead.
Hi. One question I wanted to understand is are you looking to raise additional capital over the next 3 years? Because while this is an investment phase, and more so because I think you have been outlining in your investor presentation plus earlier calls that you're looking for synergistic M&A opportunities, right? So that's the first question. The second was also mentioned that you're looking for some licenses, right? Could you just share some light on that, please?
So both very interesting questions. Firstly, on capital, I think our strategy remains clear as it was over the last few quarters. I think for the core business, we are well funded. I think Raghvendra in his talk alluded to the capital that exists. We are a net cash positive company. We have zero debt on our books. We have 87, Raghvendra, what's the number? 88 crores? 87 crores of cash.
Yeah.
So there is no immediate need for us to raise money per se, right? Number one. Number two, as M&As become real, yes, there would be need for raising capital, but we are a listed company, so to some extent we have a little bit of flexibility on that as well. But I think capital raise is going to be driven largely from an M&A standpoint rather than from a building the business and burning the cash standpoint, right? Because we are not doing that. So that's really the conversation on that. In terms of licenses, it's very interesting, right? Every time there is a new regulation or new opening up of thoughts that comes in from RBI, we obviously get excited. And the most recent one has been about RBI allowing NBFCs to issue credit cards. Now think about it this way, right? I have iSerview as my engine, which is actually providing the entire ecosystem for issuing prepaid cards, etc., to some players, right? Providing the technology stack, the API stack, right? Niyogin as an NBFC could actually take a license from RBI if RBI agrees to give it to us. I mean, we stack up in terms of what parameters they put in the public domain, right? You need 100 crore net worth, so on and so forth, right? If we could be the entity that issues a credit card, so tomorrow all the new fintechs which are issuing credit cards, we could provide a one-stop solution saying you don't need a bank, you don't need to go to a tech provider. We can give you the entire stack in one shot. For that, I need to have the ability to issue a credit card, and I need to have this tech stack for being able to managing the entire credit card processes. And credit card is one point, right? It could be a prepaid card. In rural India, I think prepaid cards will have far better relevance than credit cards. But nevertheless, it is what it is. So we are thinking about licensing in that sense that we should be taking, it's not in my hands. We can apply. It's for RBI to think us to be appropriate enough to be given a license. But we think our business gets significantly enhanced when we get licenses like this. So every time there is some change in regulation or RBI is willing to extend a little bit to the NBFC market, right? We're all there in the line to take care of those licenses to be able to expand our business better.
Understood.
Sure. Thank you. In case anyone else has a question, you may please raise your hands.
I think we still have one question to be answered by Sanjay. He asks, can you share the percentage of fee charged per transaction?
I think it's not per transaction. What happens is, it varies. I stand corrected. If it's a micro ATM transaction, it's per transaction. In AEPS, it's per transaction. In domestic money transfer, it's a percentage. But the way we calculate, the way we look at these businesses is these are all the yield on the throughput is anywhere between 30 basis points to about 80, 90 basis points. The DMT business is sitting at about 70, 80, 90 basis points. The AEPS micro ATM business is sitting at between 30 to 40, 45 basis points. That's really what is the way we calculate the math.
Thank you. Mr. Sanjay has a follow-on question. Mr. Sanjay is asking, what are the major risks that we face in this business?
So I think the most important risk that sort of keeps me up at night is that are we working hard enough in terms of being able to execute faster? Because there is a market out there. We think it's a virgin market, but virgin markets don't remain virgin because people catch on to it. We've got a real solid footprint in rural India, and we need to be able to sort of capitalize on that rural footprint for us from a business standpoint. From a risk standpoint, some of the traditional risks that you would see, for example, fraud risk, etc., since we are dealing in some sense a little bit of cash. Now there are checks and balances, right? There are real cash transactions happening between the retailer and the customer, right? And we are disintermediating or playing a role in that. That's something which we need to be very, very cautious about in terms of having our checks and balances in place. There is a significant level of technology businesses fundamentally need to have appropriate redundancies, right? Our customers depend on us. When they give us when we put our platform, when they depend on delivering customers to their platform, one of the things I worry about is this robustness of our platform. So we've invested a lot of money and effort in the robustness of our platforms to make sure that the downtime is absolutely minimized. The efficacy rate or the transaction go-through rate is extremely high, because these are all data points which are important from a customer standpoint that keep us in business. So the technology risk is very important, right? Obviously, everyone worries about obsolescence of technology. I think we are at the cutting edge right now, so I worry less about it. But we want to worry about it at all points in time because we want to make sure that we are at the cutting edge. The databases we use are unique. I don't know if anyone else uses. There's a company in the US called Cockroach database. We use their database, right? We were the first company in India to bring that technology into India. Of course, I'm sure multiple people will be using that. This is a database that is residing over multiple servers, right? And gets updated automatically across all those servers, creating appropriate redundancies. So we brought in some of the newer ideas and newer thoughts, right? Similarly, we've now got integrated with MPCI. I don't know of too many other fintechs that are directly integrated with MPCI. Everyone really puts their transaction through a bank. And we reduce a hop because we go direct to them, right? Now that one hop could be a few milliseconds, but it enhances the customer, experience. It reduces our dependence on somebody else's technology, right? Which I think is important for us. So we are happy owning our technology, then we are in control. So these are some of the things we worry about, yeah. But nothing which I'm worried about right now that's staring at me like a real problem at hand.
Thank you. In case anyone else has a question, you may please raise your hand. Yes, Mr. Pratik, you may please go ahead.
Hi, one last question. How should we look at FY23, right? As in terms of business, tech, etc., right? As in how would you define the milestones for the coming financial year?
Yeah, so
what we should track towards?
So Pratik, I have not really given targets for next 1 year because next year is going to be a very different year for us. It's going to be a year where we are going to be expanding, growing, but we're also going to be building, right? So if I had all the tech stack already built out and I just had to expand, I would have given you a target, right? But because next year is going to be a bit of both, I think we have not given anything in the public domain. Rather, we've given targets 3 years because we think that all the builds would have got done. And then we would just be in the expansion mode. So there would be some stability for us to give a number that we are happy to execute against. So that's the way I think about it. But if I look at I can still put out there certain targets in terms of our, growth, in terms of the footprint, in terms of some of the partners that we have. Again, these are numbers that come from the partners that we operated, right? On what CSE wants to see, what India Post wants to see, what Bhafin wants to see. right? Those numbers are pretty staggering. So we need to execute against those, but we haven't really put a number out there for the next 1 year.
Got it. Thank you very much for your answers.
Thank you. In case anyone else has a question, you may please raise your hand. In case anyone else has a question, you may please go ahead and raise your hand.
Yeah, I think we've been very efficient. It's not 6 o'clock, so
yeah,
we've kept to our time.
Tash, we'll just wait for 1 minute more in case anybody else wants to ask a question.
Sure.
Sure. Thank you. I believe that since there are no further questions, I would now like to hand it over to Tashwinder for his closing comments.
Yeah. So firstly, thank you everyone for joining again on this Monday evening. We are very excited with what we're trying to build. I really appreciate your taking the time to listen to our story. Please to keep logging in. Please keep listening to our story. It's a very exciting place that we are operating in, and would love to keep sharing our milestone journey as we progress quarter on quarter. Thank you again, and we remain available in case people have follow-on questions. Please feel free to send them in. I think Ravi's already shared email ID where you can send in your questions, and we will endeavor to revert back to all of you. Thank you so much.
Thank you. That ends this call. In case anyone else has any further questions, as Mr. Tashwinder said, please do write to us. Thank you and have